Have you ever wondered why the price of silver seems so disconnected from reality? You see headlines about skyrocketing demand, coin shortages, and mints running out of supply. Yet, when you check the market price, it's often stagnant or even falling. What's going on here? Is there something happening behind the scenes? A hidden hand influencing the value of one of the world's oldest forms of money? Today, we are diving deep into the world of silver, exploring the controversial claims of market manipulation and the battle between paper contracts and physical metal. This is the story of a market that many believe is at a breaking point. To understand the situation, we need to talk about two different kinds of silver: physical silver and paper silver. Physical silver is what you can hold in your hand: coins, bars, and bullion. It's tangible, real, and has been used as a store of value for thousands of years. Paper silver, on the other hand, is a financial instrument. These are futures contracts, ETFs, and other derivatives traded on exchanges like the COMEX, which is part of the Chicago Mercantile Exchange Group. These contracts represent a promise to deliver silver at a future date, but here's the crucial part. Most of these contracts are never settled with physical metal. They're usually settled in cash or rolled over into new contracts. This creates a massive discrepancy. For every 1 ounce of actual, physical silver available for delivery in the COMEX vaults, there can be hundreds of paper claims to that same ounce. This is what's known as leverage. It is a system where the amount of paper silver traded vastly outweighs the amount of physical silver that actually exists in the registered stockpiles. And this is where the allegations of price suppression begin. Critics argue that large financial institutions, often referred to as bullion banks, can use this paper market to their advantage. How? By creating a massive supply of paper silver out of thin air. When they want to drive the price down, they can flood the market with short sell orders, bets that the price will fall. This deluge of paper supply overwhelms the genuine demand from buyers, artificially pushing the spot price lower. It doesn't matter if people are lining up around the block to buy physical silver coins. The paper market, with its immense volume, dictates the global price. Think of it like this. Imagine a small town where there are only 100 apples available for sale. But in a separate apple contract market, people are trading promises for 1 million apples. The price in that contract market, not the price of the actual 100 apples, is what everyone accepts as the price of apples. It's a system that seems detached from the fundamental laws of supply and demand. Over the years, we've seen numerous instances that fuel these suspicions. There have been massive, inexplicable price drops happening in the dead of night, during periods of low trading volume, when a single large sell order can have an outsized impact. These are often called paper raids or smashdowns. A huge number of contracts to sell silver are dumped onto the market in a matter of minutes, causing the price to plummet. Retail investors wake up to find the value of their holdings has been slashed, while those who initiated the short sales can profit by buying back their positions at a lower price. Many market analysts point to regulatory filings, such as the Commitment of Traders report, as evidence. These reports often show a small number of large commercial banks holding massive short positions in silver, positions that seem designed to cap any price rallies. Whistleblowers have even come forward. Former traders have testified about the practices within these institutions, describing a culture where manipulating precious metals prices was just part of the game. Despite fines being levied against some major banks for these activities, many believe the penalties are just a cost of doing business and don't address the systemic issue. Now let's look at the other side of the coin, the physical market. While the paper price has been under pressure, the demand for real, physical silver has been exploding. In recent years, we've seen unprecedented demand from both individual investors and industrial users. Silver is essential for solar panels, electric vehicles, and countless electronic devices. Its role in the green energy transition means industrial demand is set to grow for decades. At the same time, investors, wary of inflation and economic uncertainty, have been flocking to silver as a safe haven asset. This has led to widespread shortages of popular silver coins and bars. Major government mints, like the US Mint and the Royal Canadian Mint, have repeatedly announced they couldn't keep up with demand. Retailers have had to charge significant premiums over the spot price just to source the metal. This premium is the gap between the paper price set by the COMEX and the real-world price you have to pay to get your hands on physical silver. When this premium widens, it's a clear signal that the paper price is not reflecting the true physical market reality. So, we have a tale of two markets. One is a digital world of leveraged paper contracts where supply can be seemingly infinite. The other is the physical world of finite supply and roaring demand. The big question is, Can this disconnect last forever? Many believe we are approaching a critical moment. The theory is that eventually, a critical mass of investors will demand physical delivery of their contracts instead of settling for cash. This is what's known as breaking the COMEX. If enough contract holders stood for delivery, the exchange wouldn't have enough physical silver in its vaults to satisfy the demand. This would expose the fractional reserve nature of the paper market and could trigger a massive repricing of silver, where the price would have to surge to reflect the true scarcity of the physical metal. The entire paper pricing scheme would collapse, and the value of silver would finally be determined by actual supply and demand. Could this really happen? It's the billion-dollar question. The forces maintaining the status quo are incredibly powerful, but the pressure from the physical market is relentless and growing. The flow of silver out of registered vaults and into private hands continues unabated. Each ounce that leaves the system is one less ounce available to back the mountain of paper claims. What we are witnessing is a fascinating tug-of-war. On one side, you have the paper market, a powerful tool for price discovery that critics say is being used for price suppression. On the other side, you have the undeniable fundamentals of the physical world, dwindling supply, record demand, and a growing number of people who want to hold real money, not a paper promise. This isn't just about making a quick profit. For many, it's about financial freedom and protecting their wealth from a system they no longer trust. It is a vote of no confidence in currencies that can be printed without limit and in markets that seem disconnected from reality. Whether you see it as a conspiracy or simply a complex market dynamic, one thing is clear: the silver market is at a crossroads. The tension between the paper price and physical reality cannot stretch forever. Something has to give. The only question is when. Thanks for watching. If you found this exploration of the silver market interesting, be sure to like this video and subscribe to our channel for more deep dives into the stories shaping our financial world. Let us know your thoughts in the comments below. Do you think the silver price is manipulated? We'd love to hear from you. See you next time.